It's 4 p.m. here at DBS Asia Central. We are connecting to you live for our April Macro Insights Livestream. I'm Temur Beg, Chief Economist at DBS Group Research, along with my colleagues Teng Chua, Radhika Rao. Hi, guys.
Hello.
Have been following anything exciting lately?
Tariff is the ODD.
Tariff and tariff and tariff. This is the second time we have come to you just in the course of the last 4 or 5 days. On Thursday, our time, which was Wednesday evening in the US, we decided to do an emergency broadcast and took dozens and dozens of questions from those who logged in that day. It's on our YouTube page and then the DBS Macro Insights page. I think we had something like 880 people attendees
Quite a lot, yeah.
to the call, and maybe about 3 dozen questions. But things have changed a lot since then as well. And there's not a day without which we go through new developments and new market-moving issues. So I have Teng and Radhika. We will focus largely on ASEAN today. I think the last call was about the global asset classes, global implication. I will touch a little bit on the US macro initially, yes. But today is really your show. The two of you can walk us through all the key ASEAN countries and the implications for that, and there's a lot to work through on that, right? So I will let them go for the time being, and let me now go through the slideshow. So as you know, the title of this presentation is ASEAN amid geoeconomic fragmentation. Geoeconomic fragmentation was a phrase that the IMF popularized about a year ago at that time, or a year and a half ago. And at that time, the premise was that since actually the global financial crisis in 2009, the world has been fragmenting. There are more and more trade restriction measures. There are more protectionist measures. And this dynamic was seen as something that would sap global growth, that would sap some degree of momentum in the global economy. The gains from trade that both emerging and developing countries had enjoyed in the 80s, but particularly in the 90s and 2000s and 2010s, was seen as something that was fading. Well, nothing has put a proverbial nail on this coffin of fading of geoeconomic fragmentation is what Donald Trump announced in the guise of reciprocal tariffs on Wednesday US, Thursday morning Asia time. So what we want to do today, as I said earlier, that Teng and Radhika will talk about ASEAN. They're breaking up the region into 2 parts, and hence a 2-part presentation. Let me talk a little bit about US economy. Although on my bullet, there is financial markets. I'm actually not going to touch on that. There will be other avenues to deal with that, and we will talk a lot about them in the coming weeks and months. Today, let's sort of stay on the economic dimension of it. But if you have specific questions on asset classes, particularly on the dollar or the rates, do reach out to us. There are 3 ways of reaching out to us in real time. There's a QR code on the screen. Scan that and submit questions through Pigeonhole. You can access Pigeonhole just by typing dbs.pigeonhole.at and entering the passcode macro. And also, if you see your screen that you're looking at, there's a chat page. Feel free on that box, write down your questions. Our studio support staff will pick up those questions and also place them on Pigeonhole, and we can take a look at them and address them later on. So now, let's move to the presentation. The impact of tariffs on countries. Some of the numbers here would be well known by now. I mean, we know that something like Singapore has one of the base tariffs, just about 10%, whereas Hong Kong, China have 54%. I'm basically reading out from the second column here on that screen, and then you have something like Taiwan, rather surprised, 32%, Indonesia, 32%. I think the leaders in these countries were quite surprised by these numbers, but that is nothing compared to what some of the other countries which are not on this screen, like the Vietnams and Cambodia, have faced. They did not see anything akin to 40-something plus coming in their direction at all. And then even Japan, EU, you can't really find too many trade barriers between these countries, the tariff or non-tariff, and even they are saddled with 20-24%. I just want to highlight a couple of things on the screen beyond the regurgitating of the tariff rates. Firstly, in the 3rd column, as you can see, exports to the US as a share of GDP, I think it's an important thing to think about. You may have some of your exporters hugely exposed to the US market, and they, of course, will face a lot of pressure right now. But how consequential are they to your economy? So think about China, for example. It's a very large country and a very large economy. While China is the manufacturer of the world, China's supply chain is the most consequential in the world, China is the largest trading partner to most countries in the world, but exports only make up 2.8% of China's GDP. This is an important consideration because when we think about the downside coming from the tariff, we need to think about how consequential those tariffs and that export sector is to that country's economy. As you can see in the case of China, it's not that large. So when we talk about the downside to the Chinese economy, as illustrated in the fourth and the fifth column of the screen, we're not talking about China going into a recession just because the US will put on 54 or maybe even 104% tariff on its exports. It would be devastating for certain Chinese export-oriented companies and certain American companies which are based in China and sell to the US. No question about that, and that would be very problematic and painful, no question about that. But we will, having taken all that into account, only shave down China's growth forecast by about 100 basis points or 1% from 5 to 4, if indeed we were to have a trade war like that. Now, there's another more adverse scenario in which the trade war-related repercussions create so much negative loop in the financial markets and US consumer and business sentiment that the US falls into an outright recession. Mind you, that is not our base case. We're not forecasting a recession as our base case. We're still talking about 2% growth with a minus 1% risk given how things are, so maybe 1. But we're not talking about negative growth in the US. But if we are wrong, our base case will need to be changed by incorporating a recessionary scenario, maybe in 2 months' time. Then we would be shaving down a little more of China's growth, not just 1%. But again, it will still not take China toward like 2 or 1. It'll be much more than that. And Moji, our China chief economist, and her team have done quite a bit of work looking at the responses coming from the Chinese side. No, I'm not talking about retaliation. I'm talking about more growth-supporting measures that would act as an offset to some of the negative that's coming from here. So that's the China story. Taiwan, Indonesia, India are countries, as I said earlier, are a bit surprised. They probably felt that they were on the right side of this trade war and the US would be kinder on them, but it's not being like that at all. I think I just want to make one major point in this context. As you know, whether it is the Prime Minister of Israel or a delegation from Vietnam or the Mexican and the Canadians and the European Union for that matter, everybody wants to do a quote-unquote deal with the United States. I will drop trade barriers, I'll drop tariffs, and hopefully you will take away your tariffs. I think just about 90% of these countries are in for bitter disappointment. The US is in no mood to reduce tariff on anything. Just before I came to this call, I was reading the Financial Times, and Peter Navarro, basically the trade czar of Donald Trump, wrote an op-ed there, and his point was clear, that for the likes of Cambodia, the likes of Vietnam, the likes of Mexico, they're seen as quote-unquote cheaters, that they allow China to transship through them and come to the US, avoiding the tariff on China. These countries will be punished. It doesn't really matter if they put zero tariff on US exports to them. They will be punished for their misdeeds of the past decade or so. And hence, if that is the mindset, then there's no question of reducing tariff. These countries can go ahead and reduce all the tariff as they want. The thing that will they get in return would be market access in the US. You want to sell to America, you produce in America. Tariff, in my view, will not go down. I will be really, really happy if I'm wrong on this prognostication. I fear I'm not. I want to talk a little bit about the scenarios that's out there, and I apologize to those of you who are looking at it on a telephone or on a phone screen or a small tablet because there's a lot of words on this screen. This is not my preferred method of presentation, but this is one of the scenarios where we probably need to do it. So I urge you to download this from our website after the conference call is over, and you can read through it, the PowerPoint or the PDF versions. So the scenario one that we have in mind is right now still a 45% probability that the US sees a discernible slowdown in growth momentum and some pickup in inflation momentum as tariff and uncertainty work with their way through it. But there's sufficient underlying strength in the US economy that the US doesn't go into an outright recession. In that scenario, I would call it like a stagflation light type scenario. Maybe the US sort of gets away by slowing to about 1% growth and not more than that. And around that, the Fed worries a bit about inflation expectation and inflation picking up on a hopefully one-off basis around tariffs, cuts by a couple of times, but not more than that. Trump may not be happy with Powell, but US markets sort of find their bottom and they start looking forward to tax cuts and deregulation, and life goes on, sort of a low-level equilibrium, if you will. But I'm going to assign 35% probability to that base case being wrong. And in that scenario, the US does tip into a recession, -1%, -2% growth or something like that. And in that scenario, we will have problems. It's not stagflation anymore. Inflation is not the biggest worry. It's the labor market. It's the overall state of jobs and wages and solvency of companies. And around that scenario, even if inflation is temporarily high, the Fed will look through that entirely, focus its attention on substantial amount of support for the economy through rate cuts, through reversing QT into QE or something like that. In that scenario, expect 150 basis points. Basically, every single meeting from June onward, the Fed would cut. Now, you thought that was the worst case scenario? No, there's an even worse scenario than that, which is the recession turns into a deeper recession, -2% growth, and then the negative spillover for the whole world is seismic. We have financial stability issues, we have solvency issues, and around that, the Fed even more aggressive, cuts rates down to 2.5%, but nobody's going to be celebrating the decline in mortgage rates or decline in auto loans at that point. People will be worried about their livelihoods, whether it is assets or jobs. That would be the concern. So not exactly something that anybody wants to happen. And of course, the systemic implication for global financial system, global economies would be substantial. Okay, now, just for the sake of considering all possibilities, I have a 5% scenario. And the 5% scenario is not a recession, not stagflation, not financial stability, but rather the market gets played by Trump. Meaning, right now, lots of doom and gloom, but in a month's time, some deals are done here and there, tax cuts come to the fore, deregulation comes to the fore, and we actually see the market sentiments turn around in a very big way. Bottom fishing stock investors come back, Tesla to Bitcoin, everything rally, and then we have the problem that something that we were worried about at the end of 2024, which was the US was at risk of overheating. Overvaluation, stretch valuation, overlending, a lot of risk percolating under the surface, but because asset prices are going up, they don't come to the fore. In that scenario, guess what? The Fed would actually hike rates, because then tariff plus overheating would mean inflation expectation would go through the roof. Now, I'm assigning only 5%. It was a non-zero probability. Keep this in mind. Maybe it's not 5. Maybe I'm underestimating that scenario as well. Okay. We have been doing a lot of work on what we call growth at risk. Because you see, at this point, publishing forecasts and revising them every 48 hours is rather pointless in my view, because it is really one person's whim that determines this forecast right now. I'm not particularly inclined to change my forecast based on Donald Trump's speeches and tweets. If there is substantial reason to believe that whatever policy has been put in place is going to be there for a while, then we'll go ahead and make substantial changes to our forecast. My view, which is that tariffs are here to stay, may well be proven right, in which case we will take those risks to our forecast and put them into our baseline. But for the time being, I'm not being so confident that my analysis and my thesis is the right one, and hence I'm staying on the sideline. And my team has done quite a bit of work in the last 72 hours looking at these risks to our forecast. And again, I would urge you to download this file. It's hard to look at the screen and go through this line by line. But the bottom line is the more a country has exposure to the US economy, the more its growth is under risk at this point. So the likes of Vietnam, Taiwan, Thailand, we would worry the most about. The likes of India, Indonesia, we would worry the least about. And China, Hong Kong would be somewhere in between. Finally, I did say that I don't want to talk too much about markets, but I think a little bit of stock taking with respect to rates is required. The market is now saying 100 basis points of rate cut this year. It might say even more very soon. But as you can see, the market has been all over the place in the course of the last 6 months. It's a 6-month chart, the left panel that you have. October 2024, the market was expecting 125 basis points of rate cut in 25. Then it gave it all up, almost down to no cuts at one point, I think in January of this year. And since then, again, more and more doom and gloom, more and more expectation of rate cuts. And again, now we're back to 100 basis points of rate cut for this year. If you look at the yield curve, they have shifted down, both the US and Singapore yield curves. But the long end is showing some peculiarities. If I were to show you what has happened with the long end interest rate over the last 24 hours, you'd be surprised that it has gone through both a sell-off and a rally, and then a sell-off again. Through the course of yesterday, we were at 3.8%, I think 10-year. Now we're about close to 4.1%. So it's a lot of noise. Is inflation and stagflation the reality down the road? Is it depression or a recession? Nobody quite knows. In fact, I have a colleague who just came back from the US, talked to many seasoned Wall Street veterans, and ex-government officials, and the one common phrase from all of them was, I don't know. I don't know. Nobody really knows where things are going, and which is where the market keeps on struggling to price the outlook for assets. All right, I'm going to stop right there. Enough about the global outlook and so on. Let's now move on to Teng. Teng will, again, talk about ASEAN, and after Teng, it'll be time for Radhika to cover the rest of ASEAN. So Teng, all yours now.
Yes, great. So thank you, Tamer. Now me and Radhika will take everyone through our views on ASEAN with respect to the developments of the tariffs. But before that, if you have any questions, please head to this Pigeonhole QR code or the website here, or alternatively, there's a chat box that you can enter your questions, and we'll be glad to answer them towards the end of the live stream. Now, first of all, I think when thinking about what the US has done, the formula that it has come up with to in its reciprocal US tariffs announcement is really to seek to correct trade gaps with some of its trading partners. And here I think ASEAN 6 is particularly hard hit, given that some of the countries here like Vietnam, Thailand, Indonesia, Malaysia are the top 15 partners that the US has deficit with. And therefore, what you see here is that the reciprocal tariff rates that have been announced has been quite large for these countries. Singapore is the only one that has a favorable trade balance with the US, and therefore it is being subjected to the baseline 10% US tariff rate that has already come into place starting from the 5th of April. And we try to gauge the growth impact of the tariffs on the ASEAN 6 region, and we consider a number of things. So I think firstly, the key thing that we look at is the increase in the US reciprocal tariff rates, which is shown in the chart here, where Vietnam, Thailand are experiencing the largest increase of 46% and 36% respectively. To the other spectrum is Singapore, facing the baseline rate. Here, we will also like to consider the exposure of ASEAN 6 economies in terms of their goods exports to the US. And here, there's some correlation in that sense with the trade gaps that these countries have to the US. Here you can see that Vietnam is really exposed with almost 30% of its goods exports headed to the US, followed by Thailand at around 18 to 20% of total goods exports. And these two countries have certainly increased their trade share, export share to the US over the years, particularly since Trump 1.0. Singapore here is the least exposed to US exports at below 10%, 8.5% to be exact. And perhaps on that front, it is less directly being hit. Other than these two considerations, we also must take into account the export elasticities, and that would be sort of correlated with how trade dependent the economies are. So here we have summarized the direct growth impact that we expect after the reciprocal tariffs announcement. And here we have shaded it in various colors so that you can look at it easily. And red would show a really high impact. And earlier, I think Tamer showed the table where Vietnam would see a downside risk of around 2 to 2.5 percentage points, whereas other economies like Thailand, Malaysia would also see quite a huge impact, whereas others like Indonesia, Philippines, Singapore will be less hit. And Radhika will delve more about Indonesia and Philippines later on. What is key in this reciprocal tariff announcement is that certain key items were exempted, particularly semiconductors and pharmaceuticals. And prior to the announcement, Radhika and myself did a quite in-depth analysis on what the impact may be on if there were 25% tariffs on semiconductors and pharmaceuticals. And here we also classify it as a heat map, where in fact Malaysia is the most exposed in terms of the US semiconductor imports. Then therefore, if tariffs is being imposed there, which there's still some pipeline risk, then Malaysia is probably going to get hit the most, followed by Vietnam and Thailand. In terms of pharmaceuticals, Singapore really stand out in terms of being exposed to US pharmaceutical imports from Singapore. And that is certainly a risk we should watch out for, given that I think just judging from the reciprocal tariff announcements, no economies are immune from further tariff action. Now let me touch more upon Singapore. And just now we mentioned about it being subjected to the baseline 10% tariff rates. And therefore, I think on that judgment, on a relative basis, Singapore is in a better position. But I think we need to understand that it's still being exposed to a global slowdown risk. Just looking at direct exposure, although it may be small compared to other ASEAN peers, we need to recognize that US is also still among the top 5 good exports destination for Singapore, slightly below China, Hong Kong, and Malaysia. But I think the key thing that we need to watch out is the secondary impact, where there is a deep global slowdown, particularly in trade and manufacturing, that is being induced by the hike in US tariffs. And here I have a chart where I try to map the value added to US imports. And here, Singapore being very deeply integrated into global supply chains would be impacted if US imports were to have a quite deep slowdown, given that we see that the value added by Singapore to US imports is quite high at around 9% of GDP, quite similar to that of Vietnam. So in the event that there's a deep global trade slowdown, Singapore would certainly not be spared. Now, next Monday, the MAS would be announcing its April monetary policy statement. And we just released a chart book yesterday, talking about the implications of the trade war, which I also just discussed, and also our view that there's scope for MAS easing in the April decision. So just to recap, MAS has slightly reduced its slope of its Singapore NER policy band during its January meeting, basically due to increased growth uncertainties, but also inflation returning to a low rate starting from 2025. And given that the risk for Singapore in terms of the growth and inflation outlook is skewed to the downside, we think that the MAS has scope to further reduce the appreciation pace of its Singapore dollar NER policy band at its upcoming meeting. So we will certainly be watching quite closely what MAS will do in its upcoming meeting next week, where at the same time the first quarter advanced GDP estimates will be announced. While the first quarter number may be quite resilient, we still have to be aware of the upcoming growth risks that might be coming soon due to the US tariffs. Now, on the other side of the spectrum, now let me focus on Vietnam, which we think faces concentrated risk to the US, as I've mentioned just now, where their goods exports to the US is almost 30%. Here, Vietnam is one of the economies that have announced its GDP numbers. And for the first quarter of 2025, the numbers may look quite resilient, where the headline growth came in at 6.9% year on year, compared to 7.5% in the previous quarter. This basically sort of masks the upcoming deceleration that is probably likely going to happen given the impact from US, the steep increase in US tariffs of 46%. And here I think the export-oriented manufacturing sector is particularly exposed. In the middle chart, I show here the top goods exports exposure to the US, basically the top 6 goods exports that is within Vietnam's exports basket, as well as the exposure to the US for each of these categories. And here you see that a couple of categories stand out, particularly in electronics products, such as electronics components, smartphones, textile and garments, as well as footwear, and in particular, wooden and furniture products, where around 50% or more head to the US. Textile and garments are also quite exposed, with 40 to 50% of that heading to the US. And therefore, I think you also see about the negative news that's hitting Nike, which has major operations in Vietnam. And ultimately, I think when you look at the comparative advantage between the US and Vietnam, Vietnam has a comparative advantage in some of these products, including textile garments, footwear, and wooden products. And therefore, the hit is likely going to be on the US consumers, where they either face the higher prices that are fed through from the increased tariffs, or they reduce the demand for these goods. And lastly, if not, then it would be some of the manufacturers, multinational manufacturers that are based in Vietnam, that would take a margin hit from the increase of these tariffs. Lastly, I would like to consider the US tariffs increase that Vietnam and China has pre-Liberation Day and post-Liberation Day. And that's a quite steep increase if you see here. So prior to Liberation Day, I think the tariff differential between the two countries have been quite wide. But after the increase, you see that there's such a huge increase in the tariff rates, and even if there is still a positive tariff, even though Vietnam still has a favorable tariff differential relative to China, it might be quite difficult for manufacturers to operate in Vietnam for low-cost goods and then still export them to the US. I think tariffs will be one consideration for manufacturers that are looking to serve the US market from Vietnam. Now, my final slide of Vietnam would be in terms of the FX. And here we've seen that actually since US started to impose tariffs on Canada, Mexico, and China starting from February, Vietnam has also started to tolerate FX weakness, where the fixing of the Vietnamese dong has been on the weaker side. And there's a dilemma that Vietnamese policy makers will face going forward. Given the increase in tariff rates, there's going to be an increased downside pressure on growth. By the same time, the Vietnamese dong is also going to depreciate. And therefore, there's a choice that they have to make between the two. It seems like the Vietnamese authorities are tolerating some FX weakness to sort of offset some of the competitiveness that's being lost. And by tolerating this FX weakness, this probably will give them some room to lower policy rates if they wish to support growth going forward. So let me end my discussion here on the first part of ASEAN and pass the time to Radhika, who will explain the rest of our ASEAN views.
Thank you so much, Teng. Hi, good afternoon, everyone. Thank you for joining us today on this call. So what we're going to see is, really Teng drew out very well in terms of what the backdrop of and discuss some of the countries, especially Singapore and Vietnam in greater detail. And what I have in store for you, so just to build some context on why we decided on speaking about Singapore and Vietnam, these are actually just two ends of countries that saw Vietnam face very high reciprocal tariffs, and Singapore is at the baseline tariff, which is at about 10%. And you also see them at different spectrum in terms of the share of total exports that they sell to the US, or the share of their exports to the US. Hence, we discuss on those two extremes. What I'll take you through is Indonesia and Philippines. There's some common ground between these two countries. Essentially, they do export to the US as well, and of course, their share is somewhere between 10 to 15%. But that said, the reciprocal tariff treatment on both these countries is quite different as compared to, again, the other two that we spoke about. So let me then dig into Indonesia to start with. And it's of interest because Indonesian markets have just returned today after a week's break for Lebaran. Certainly there's a lot of pent-up action that was likely, the stock markets, while much of Asia has kind of stabilized, the Indonesian stock markets opened down, hit the circuit breaker, and then since then are moving sideways. The rupiah also came under pressure, was at a record low at one point in trade. Certainly the central bank has been very proactive, and they've already taken a lot of intervention action. They did that in the NDF market, and then they've gone into the onshore markets as well. Insofar as the tariff is concerned, we did expect, again, bulk of ASEAN countries, there was bound to be some, imposition of reciprocal tariffs. But on Indonesia's case, we were a bit perplexed by the extent of the tariff increase. Upwards of 30% reciprocal tax has been imposed on Indonesia, which is very high considering the tariff differentials between India and the US are Indonesia and US are a bit mixed. To mean that there are some categories where US tariffs are higher than what Indonesia imposes, and vice versa. A potential flashpoint, perhaps, on why they could have been higher, or why there was higher action or more stringent action in Indonesia, is that China is a very active partner for Indonesia in terms of exports, as well as an FDI investor. So we did think that that was a potential flashpoint, and perhaps that's why there is a bit of an outsized reciprocal tariff that has been imposed on the country as well. But that said, if you look at the product breakdown, it's quite clear that there's a mix of labor intensive as well as slightly high-tech kind of production engines. And when we see through the USTR report, in fact, on the non-trade barriers, there is a lot of emphasis on import licensing requirements, export restrictions, even something with regards to the local content requirements. And I think what comes to mind is what the US company Apple faced in Indonesia recently when they were asked to invest more to allow for iPhones to be sold in the country. So quite a fair amount of time in the report being spent on the non-tariff barriers, and we do think that besides China being very important for Indonesia in terms of trade, perhaps that was again one of the factors why, which is the non-tariff barriers, because of which Indonesia faces quite high tariffs at this point. I'm also reproducing a chart on the extreme right, which is what Teng had shown earlier, which is again to show growth impact in the region. Fortunately, even though the tariff rate is quite high, for Indonesia, we do think that the impact on growth would be relatively less, which is we see it about 40 to 50 basis points on annual growth. And I also wanted to bring in the fact that global environment is very uncertain. And Indonesia's case, investors are also waiting for some clarity on domestic issues. Since handover in the presidency, there's been an emphasis on spending a lot more on fiscal programs, and there's some clarity required on the revenue part of the equation as well. And so not only global but local as well, and that could be something that investors would prefer to watch out for in the coming weeks. From Indonesia, I then shift gear to Philippines. Now Philippines is, and the chart on the top left is interesting because again, just like Indonesia, Philippines exports overall to the US. It's a very small percentage of GDP, which kind of gives you also the sense that if there is an impact, it won't be very big. And I think Philippines finds itself in company of India and Indonesia, as you can see in this chart, and it's about ballpark of about 2% of GDP. In terms of the product groups, semiconductors and especially the assembly and marking part of it is quite, Philippines is quite big in that space. So that could be one of the lines that could be impacted, especially when semiconductors face tariffs as well. We think it's a matter of time before that sector comes into view. But then again, you can see some other telecom instruments, you can see some crude materials as well as food and agri. Those are some of the key exports that Philippines sells to the US. Then I bring you to the heat map below, and the takeaway from that is you can cut it many ways, right? You can cut it in terms of what's the share of Philippines exports to the US, what's the share of goods imbalance between the two countries. You can also talk about semiconductors, farmers, whichever way you cut it. We are of the view that besides Indonesia, Philippines is another country where the net impact is likely to be much smaller than, say, compared to Vietnam, or if you take a look at the Northeast Asian countries, Taiwan as well. So we would put that again, impact on growth at about 40 to 50 basis points in Philippines as well. So that is a very quick wrap up on what we think of Indonesia and what we think of Philippines. Let me then take you to tying it all together in terms of the overview of the impact. Like I said, a few sectors have been left behind. Auto, steel and aluminium, we did see some announcements, but pharma and semiconductor for the time being has been left out. Again, exemption does not mean zero taxes. We do think that announcements will come over the next few weeks. Of course, markets right now are hoping for, as Teng had touched upon it, that there would be some reprieve, say a 30-day window, 90-day window for the trading partners to actually make some adjustments. But nonetheless, these are two sectors we are looking at closely, especially pharma and semiconductor being quite important for countries from Singapore to Vietnam to Malaysia as well as Philippines, as we just discussed. So impact asymmetrical, depending on which sector exposure is more. But in terms of the country exposure, as we shared earlier, we do think that Vietnam will be the most impacted, followed by Thailand, and the other end, we've got Indonesia as well as Philippines. Now that we have kind of assessed the growth impact, what the dynamics for these countries are, we can't go without talking about the policy response. No government, no central bank is going to sit on its hands, and certainly there is a lot. If you've been just tracking the news for the past 3-4 days, regardless of it being a weekend, you've got a lot of government, central banks coming out to say that they're going to take action. And when you look at the action from or the market pricing from the Fed and the market pricing for the region is kind of divergent. Now, inflation, this entire tariff arrangement development is seen as a net. It's inflationary for the US. On the other hand, there's a high likelihood that it will be disinflationary or deflationary for Asia, especially ASEAN. Not only the tariff point, because there's going to be a redirection or rechanneling of exports. If China, for example, can't sell to the US or it's become very expensive to sell to the US, they would prefer to rechannel to one of the ASEAN countries or Northeast Asia or Europe. And that would mean that there could be some cascading tariffs, which is the countries who are receiving these goods, if they do feel it's challenging their local production houses, they kind of impose tariffs as well. We have in fact seen that from 2 countries already. Vietnam and India have taken already some action on steel imports, say for instance from China as well as from South Korea. Coming back to the inflation and policy response bit, inflation environment we do think will be quite conducive, keeping the door open for policy easing. You could oil prices are at very, very moderate levels, especially countries which are highly dependent on oil imports. This is good news. And on the demand side as well, because of the uncertainty overhang, we do think demand will not be, wage spirals and all of that will not be a risk for this part of the world. So we do think that the door remains open for rate cuts. I guess the only factor that might change the pricing would be currencies. If the currency is under extreme pressure, you might see pricing of rate cuts being pushed back. If the currency is doing okay, then it will be on board. So from countries like Philippines, from like Indonesia, we do think there is scope to lower rates this year. So central bank action is one, fiscal action is another. Again, if you compare to the Western world, debt levels in this part of the region is not that big or not that high. But quite a few of the countries are near their thresholds. Anything between 30, 40, 60% is usually seen as levels. You don't want to take debt levels above that. Here I'm talking about the public debt levels. So from that point of view, and also in this environment, it's going to be hard to raise revenues. That means the governments, if they want to support business, support SMEs, they will have to reprioritize, rechannel their spending into much more developmental or financing costs, or that kind of support provided to businesses. So these are 2 channels we think that support could come by. Monetary policy, still ample room. Fiscal policy, not so much, but there's still room if the governments decide to rechannel their spending priorities. This then brings me to the way forward. We have discussed what happened, what was the impact, what policy response could come by. And of course, businesses are increasingly, and we've been, all of us in the team have been speaking to quite a few clients in the past few days, and there's a lot of interest in where to from here, right? So we try and give you kind of a sense of what we are looking at and what are the other announcements you might hear from the region. The first one is a collective regional response. Barring China, you haven't really seen many countries from this region already talking about retaliation. Most of them are keen to reconcile. They're keen to see where they could bridge the gap with the US, try and provide some concessions, get some relief in return. So those conversations are just about starting. In fact, Malaysia is the ASEAN chair this year, so they've already spoken about a regional response, a collective response, bringing it forward to the US, because if you see the reciprocal taxes, it's among the highest that have been imposed on the ASEAN countries, Vietnam and especially Vietnam and Cambodia. So they will look at more, conciliatory discussions. They will look at stepping up purchases from the US, and also within countries there is a small margin. Philippines only 17% tariff. You got Vietnam at about 40% plus. So there is a bit of a gap there. You could see if companies would like to route some of their exports accordingly. Then there is the competitiveness differential. There's a big discussion on will companies move en masse to the US. End of the day, these decisions are not made overnight. There is still a lot of uncertainty on whether they could get some relief window, whether this entire tariff arrangement could be postponed, or deferred for quite a few months. In this kind of a scenario, no company is going to decide to, close shop in ASEAN and open in the US. In fact, Teng and I have also gone through some competitiveness studies to see if there is, where the US does well and where ASEAN does well. It's quite clear that whatever ASEAN produces, it's going to be very cost ineffective if US were to choose to produce that as well. So again, regardless of this tariff differential, we do think competitiveness will still play an important part, especially in some of the cost sensitive as well as labor intensive industries. And the last one is, could there be FX could be used as a policy tool? That happened back in the first term of the Trump administration. Could that make a repeat? And in terms of the intra-ASEAN collaboration as well. As the environment gets tougher, countries will look to collaborate within this region, with Europe, with UK. There is this conversation also on revisiting some of the FTAs that have been put on hold, trying to see if that can be revived. One area that is still being left out of this entire tariff conversation are services. Of course, the deficit that US has on services is smaller than it has on goods. So perhaps that's why it's been kind of left out. But if services become one of those, the other conversation piece, then I think the relationship between Europe and US can again become quite frosty, because European countries are quite big service providers to the US. And I'll just conclude with this China plus one flow. We have received some questions on, does this mean China plus one is going to be, we can bid it goodbye, or it's going to lose momentum? We do think incrementally businesses will be a bit more careful. They would like to see, which country one can be produced in. Of course, I don't think they will open, companies or branches in countries where there is a lower tariff. But if they already have production capacity in the very short term, they will look to up output there and balance their portfolio accordingly. I think with this, I conclude my part, well in time to take questions from your end. And as my fellow panelists had also mentioned, you can please post your questions on the Pigeonhole. You can go to the website. You can use the QR code. And we also understand there's a chat function on WebEx that which you're using to view this presentation. Please do feel free to put your questions there as well. And when we will take it up during our conversation now. Thank you very much. Over to you.
Thank you, Radhika. All right, let's put other questions on the screen. With the first question, I guess, Radhika, for you. Okay. Indonesian markets were better today. Will this last?
Certainly, we were, I think, watching this with bated breath. In fact, if the markets had opened yesterday, for instance, I think there would have been a severe bloodbath. Certainly today, kind of sentiments have stabilized. The equity markets in the region, I wouldn't say are rallying, but they're at least not losing ground. So Indonesia did open down. Equity markets opened down. Rupiah opened down. Sentiments were actually quite weak. But the government has been, and the central bank has been really proactive. They have already intervened. The government made some affirmative comments for the markets to kind of stabilize sentiments. So it's a bit of catch-up that Indonesia is playing today. But we don't think it would last. So 1 or 2 days, and then it should just map then what the region is doing. But again, like we emphasized earlier, Indonesia has really been awarded with a very outsized tariff. So I'd be keen to see how the government addresses that.
Yeah, me too. I think among the countries that we're talking about being blindsided by it, Indonesia is certainly one of them. All right, next question. India is not covered here, but what is their state? Will the market be worried? Should I buy?
Certainly, I think you've come to the main question, which is that should we buy? So of course, today's discussion was on ASEAN, but interestingly, India has been one of the countries that has, in the past 3-4 months, been very proactive in terms of reaching out to the US government. I think there was quite clear that India's tariff differentials with the US are the most adverse when compared to many countries in the region. So following the Prime Minister's visit to DC, you've also had a lot more high-level discussions that have been going on. And there's been also this talk on a bilateral trade agreement that's in the works. So the authorities are sitting tight. I think they are quite confident that this BTA will actually get them some reprieve. Coming back to the market, yes, I think the financial markets or equity markets in particular, I guess that's what is being referred to, did have quite a roller coaster ride. March was not that good. Then you had started to see a bit of reprieve. And then, of course, yesterday there was a major sell down. I would think retail investors now are a big force to contend with in the Indian markets, and we can already see them bargain hunting. So I would generally think, again, we don't cover the space, we don't cover the equity markets per se, but if you were to believe the medium-term, long-term story of the economy, certainly something to buy and hold, I would assume.
Sure. Thank you, Radhika. Teng, let me try to put this on the screen. Other than monetary easing, does Singapore have fiscal policy space to provide support in a severe global slowdown?
So I think monetary policy easing is certainly one action that they could take in the upcoming April meeting.
You just issued a note with Eugene Liao and Philip Wee this morning?
Yes, yesterday, and we went into great detail about the implications from the trade war, so certainly one to look into. But back to the question, does Singapore has fiscal policy space? In fact, I think they do, because in its recent budget 2025, they were budgeting 0.9% of GDP surplus for FY 2025. So considering that the economic outlook is dimming, I think there's certainly some room to, ramp up spending in certain areas. Building on the initiatives that are already put in place in Budget 2025. So I think in Budget 2025, they give some cash, some CDC vouchers and other SG60 related vouchers, perhaps that could be wrapped up, or other areas in terms of its fiscal policies.
Teng, I was attending an event with the British High Commission this morning, and clearly the British authorities were very keen to point out that they want to not take advantage, but certainly use this window of crisis to reaffirm their relationship with Singapore in terms of the FTA, both on the goods and the services and intellectual property side. And they are also trying to reach out to the Europeans and do the same. So it seems like one strategy for Singapore would be, as sort of, highlighted by both Prime Minister Wong's speech on Friday, as well as his parliamentary discussions today, is that Singapore may or may not be able to rely on the US, but that doesn't mean Singapore shies away from the US. It'll keep on being engaged with the US, but it'll certainly double up its efforts to engage with the rest of the world, whether it is Europe or India or UK, and also for that matter, ASEAN and China. I think that's another strategy. Instead of just saying, there's a short-term problem and we're going to spend some money to help the population, certainly on the table, and certainly there is the wherewithal for that. But I think on the structural level, I think there is some deeper thinking as well.
Yeah, I think because inherently Singapore is so exposed to global trade, I think the best solution for them is to double down on trade integration, perhaps in other areas as well, such as services. I think, extending relations to UK, to ASEAN partners, whether it's Johor, Singapore, certainly helps, I think.
Yep. And we'll be covering that issue quite a bit going forward as well. All right, next question. Is this a tariff war or a masked yield war with huge refinance of US debt in 2025? Now, US debt has two elements. One is US government debt, massive refinancing risk. But as our credit strategist, Chung Will-Young, pointed out to me earlier today, there's also the corporate debt that also has a big wall of maturity coming up in 25 and 26. But I assure you, this is not the right way of fighting a yield curve war by creating a recession-like tendency, and that then gives you a lower interest rate. Because if you have a recession with which you do get lower interest rate, you also get negative GDP growth rate. So the debt-GDP ratio does not necessarily improve because your denominator keeps on becoming smaller than expected. So I don't think you can play a game where you create a big crisis, and the crisis then allows you to refinance your debt at a lower interest rate, because the crisis also leads you to have lower activity, job losses, a massive amount of dislocation and financial stability risk in the economy. That can actually cause all sorts of distortionary impact. People may not want to hold US assets, even if the rates are lower. People may not want to buy US assets and hold them because the US may have other things to levy on countries like that. So I would be very careful about what one wants and gets. I think some people are talking about that Scott Bessent wanted lower yields. He got it, but for very, very wrong reasons. Okay, there's a series of questions on so the negotiation aspect of this. I want to touch upon this, but first, I want to talk about this question with regard to Vietnam. Do you think there'll be a new wave to move business out of Vietnam? So, Radhika Hunting, talk about this. I have my views on this thing, but you go first.
Yeah, so certainly I think Vietnam, I think from the perspective of reciprocal tariffs, face quite a high levy from the US. But whether there's a move of business out of Vietnam, I think that's would be quite challenging in that sense, given that I think there are still certain advantages that Vietnam has in terms of high quality educational workforce, cost advantages. And I think, lastly, I think Vietnam still has a lot of FTAs with other countries, and that means that, setting up factories in Vietnam means that you also can serve other markets beyond the US. So perhaps this is a chance for Vietnam to re-diversify from its concentrated exposure to the US to other markets, such as EU or other Asian markets.
Teng, absolutely spot on issue. There are a whole bunch of questions related to this thing. So I'm going to put this question up, but it's related to what Teng just talked about, which is, if you see this question on the screen right now, with China plus one essentially dead. First of all, let's question that one. I'm not giving up on that issue. Are we going to see withdrawal of Chinese investments from ASEAN? Same to Korean and Taiwanese manufacturer going to the US investment in ASEAN. So before coming to this call, I was chatting with Teng, and I said that I have a new acronym, WMUS. It's called WMUS because it stands for World Minus the United States. What is WMUS? WMUS is 71% of global GDP. What is WMUS? It is 86% of global trade. So all these questions that I'm seeing here, China plus one is dead. Are we going to see a withdrawal of investment? Is Vietnam going to see a collapse of investment? All of that presupposes that there is only one game in town, which is the United States. That is not the case. There are countries like Cambodia, like Vietnam, which probably are overextended to the US, and they will feel a lot of pain out of this. But that doesn't destroy their entire value proposition, guys. There are many other parts of the world where Vietnam can send. My Nike shoes that I import from Vietnam will be completely untouched by this trade war. Nothing to do with Trump's tariffs, nothing to do with Vietnam going into recession. Those shoes will be made in Vietnam. They will adorn the feet of people in India and the EU and the UK and China and the rest of the world. US, maybe not. But that is only one subset of the story. The world is a very big place. So there are a whole bunch of questions today. I'm feeling a bit animated about these questions because they are all basically saying the obituary of China plus one. China plus one bound for the US? Perhaps. But China plus one bound for the rest of the world? Absolutely not. I think we need to make sure that these are two distinct issues. These are not conflated together. Related to that, I'm going to try to bring one more question on the screen. And there are several questions along this as well. And of course, there's a lot of discussion about this right now. Will we see more bilateral trade agreements signed? We know that the Vietnamese, as soon as the tariffs were announced, decided to remove all their tariffs on imports from the United States. They want to send a delegation. I think earlier today, Israeli Prime Minister Benjamin Netanyahu was in Washington, D.C., talking to Trump about removing the 17% tariff, I think, on Israel. I think the Indians, as you heard from Radhika, have been talking for a while with the Americans on various trade deals. Now, if you look at the noise that is coming from the US administration, and by the way, it is noise because there are opposing views. If you read Peter Navarro's op-ed in today's FT, I think you will come away thinking there is absolutely no point in trying to do any deal with the United States. The only deal you will get out of the United States is you can lower your tariff down to 0. You're guilty of lots of misdeeds of the past. Our tariff is not going to go down. Only thing we will give you is access to the United States. You can come to the US and build, and that's all the deal you will get, nothing else. Now, if you just go with Peter Navarro, that's it, and I sort of am leaning in that direction. I don't think Trump will be in any mood to give anybody any deal at all. He wants the tariff mode. He wants to bring manufacturing jobs back. Deals won't do that. The moment you do a deal, that means the less number of jobs you have in the US and more number of jobs you have with your trading partner. Trump is not interested in that at all. He wants to bring jobs in the US. That means 0 deals. The only deal is invest in America, build in America, with American workers paying American high wages, and that's it. But that's not the only voice out of the administration. In the interim minutes when Teng was making his presentation, I was looking through my phone, and I saw that Stephen Moran, Council of Economic Advisors, he's saying, don't necessarily believe in all that. There is room for negotiation. I would urge the rest of the world to keep the White House phone ringing off the hook. So there you go. I think that the likelihood of the future is more in the Peter Navarro camp, but you may as well decide to go with whatever Stephen Moran is saying and expect that to be the case. So there were a whole bunch of questions in this area. I'm just sort of putting them all in the basket. Don't hold your hopes up for all sorts of deals, Vietnam, US, India, US, whatever, probably will be disappointing unless there's a big market meltdown and the US basically changes its course. Right now, no deal, build in the US. And on that note, we're going to end today's Macro Insights live stream. Teng, Radhika, Thank you very much for the ASEAN analysis. Truly excellent. And keep doing more work, because I think every country in ASEAN needs a lot more insights for our clients and for our internal stakeholders.
Thank you so much.
Certainly.
Thank you, everybody. Stay safe, stay well. We'll see you next month. Bye-bye.